Hello and welcome. You're listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, we do something a little different. There's a lot of fear and uncertainty in the property market at the moment, with inflation going up and interest rates going up and lots of bad news stories in the media. And it's very easy for me to sit here and on this side of the microphone and say, hey guys, here is my point of view or my perspective on the property market, etc. But I thought, well, rather than me having that story, why don't we actually talk to some people who are actually buying properties in the current market right now? So on today's episode, we have a panel discussion with 4 different investors who are at different stages of the property purchasing journey, all of whom work for Dashdot, and all of whom actually can have a perspective on what it's like to be actually buying it, how they're thinking about buying in the current environment, how are they thinking about their strategy, what does this mean long term, how are they thinking about all of this kind of stuff. And so we kind of really danced around in a few different directions. We talked about everything from investing as a millennial to how do we think about inflation to how do we think about investing timelines, what do we think about strategy. So it was really cool to get some other perspectives and to actually just have an open discussion and a panel style discussion on this topic. So personally, I really enjoyed it. Slightly different format for this podcast, but I hope that you're going to enjoy it too. I really believe that you will, because it's really great to hear from people who are doing the things that you want to do as well. So without any further ado, let's get stuck right into it. And I look forward to seeing you on the inside. Hey guys, welcome back to the Investor Lab. On today's show, we are doing something a little different. We have never done this before. We are actually having a panel discussion. And the reason I wanted to do this, and the reason I think this is going to be really, really cool, is we have got 4 different team members from Dashdot from different parts of the business at different stages of their own property purchase journey. Now, everyone that we've got here today is currently in the process of buying a property right now. I'll say everyone here, except for me and Gabby, we're in the process of doing some financing and stuff. So we're not actually in the property purchasing process, but the rest of these guys are. And so what I thought would be really, really cool in an environment where there's a lot of media noise, there's a lot of uncertainty, there's a lot of conflicting opinions, there's just a lot of, it's really hard to know what to do. I thought, what an awesome opportunity to get some insights from people on the inside who are walking the walk, not just talking the talk, and are actually investing in the current environment, digging into all of that kind of stuff. So I'm super excited to get stuck into this today and have a really cool and robust discussion and really push and pull some ideas around here. And, to all of you guys that are about to introduce yourself, like, this shouldn't just be a big pitch to just like, oh, everyone go buy a property. I'm very interested to know your genuine thoughts and fears and hopes and dreams and desires and stuff as it relates to the current environment, because that is what is important here, because I think it's a very interesting time that we find ourselves in. But that's enough from me. Let's do some quick introductions and then we can fire into some questions. So, Natalie, why don't we start with you guys?
Sure. Hi, everyone. Hey, Goose. Thanks for having us. I'm really excited to be here. My name's Nikki, and together with Natalie here, we are the co-pilots of the sales team for Dashdot.
Sales and advisory.
Yeah, I'd say.
Yeah, totally. And so, and if you like, just for a little bit of context, great. So you guys help people when they go, hey, look, I want to talk to Dashdot. I want to see if they're a good fit for me. You guys actually spend the time, and you actually lead the team that spends the time to actually work out if it's the right thing to do for that specific individual, right? So hence the advisory piece, which is really, really important there. Now, just so we're clear, like, what stage of the property purchasing journey are you guys at? If you feel comfortable, what stage of your portfolio you're at, you don't need to answer that if you don't want to, but where are you guys currently at in your purchase process? It's pretty interesting as well.
We're moments away from going unconditional. So we're in the middle of, on our second purchase of the property through Dashdot. So yeah, we're pretty excited to.
Second property in under 12 months, actually, isn't it?
That's correct. It's almost, it's probably about 7 months.
Second property in 7 months, and you guys are just about to go unconditional. That's awesome. Perfect. TJ, what about yourself?
Hey there, Goose. So I'm part of the property team. I'm a property acquisition analyst at the moment. Really excited to be on the podcast. Been a long-time listener. I'm currently on my second property, so about to settle in the next month or so, and we're looking to go again. My partner Janet and I, to go again for the third one, probably early next year, I would say.
Wow.
So
okay.
Really
so you just bought your first one, and now you're buying this, and now you're buying your second one. Yep. And what stage of that purchase for the second one are you at? Are you getting finance? Are you currently looking for a property? Where are you at?
Yeah, so we've gone unconditional in finance, so we're just waiting to settle now. So
On your second property?
On my second property, yeah.
That is so fast. I had no idea that you'd gone that fast. You only just bought
really
the first
fast,
one the other day. Yeah, I feel like
I
feel like it was like just the other day where you got your first property. That's awesome. Okay,
yeah,
so you're currently going unconditional, and also you are planning already your third one. You're like, okay, let's go again for the other one. Okay, perfect.
Correct.
That's good insight. And so you're currently a property acquisition analyst, but you're actually trained to be an acquisition manager as well. So that's a cool bit of insight too. Cool.
Yep.
And Nick, what about yourself?
So I'm the property acquisition manager. So I'm in a client-facing role, helping the clients sort of dig into the specific property and presenting the property to the clients, and also helping them work out their strategy and what sort of property we're going to buy for them. So I'm in that sort of deep in the active purchasing part of the journey. Now, as far as my own journey goes, I've bought last year 3 properties with Dashdot. And I came one, and before that, I bought one as a client of Dashdot, and then I bought one on my own prior to that. So I've got a total of 5 properties at the moment. They're all multi-dwellings, just because I'm a cash flow hound. And I'm currently in the final throes of going to active search to buy a house in my self-managed super fund.
Awesome.
So that's taken a lot longer than I expected, and there's all those little admin things like getting the money out of your industry fund or whatever it's called, the government type managed fund, and into your actual account. It's a big process around that, and that's the latest hurdle. Hopefully that's the last hurdle. So I've got the funds there ready to actually pay my component of the purchase cost, and then I'll actually be able to go into active search, because I know things happen pretty quickly once we're in active search at the moment.
Awesome. Okay, cool. So you are literally you're in the starting block. So Nikki and Natalie, you guys are about to go unconditional, or you're about to go unconditional and start settlement of your property. So you're like in it. You're about to and TJ, you're in the same position. And Nick, you're actually lining up. You're putting your feet on the starting blocks, ready to run. Okay, that's cool. That's awesome. Okay, so I'm going to start with you, Nick, because I'd love to just get some conversation going here. Why are you choosing to invest right now? Like, how are you thinking about investing in the current environment, and why are you saying yes when other people are saying no or maybe?
I guess, like, in the broader perspective, the people, the media in particular, when they're saying no, now's a bad time and prices are going down, they're kind of talking, they're expanding what's happening in a very small subset of the market and implying that that's happening over the whole market, and that's just fundamentally wrong. So yes, some house prices are going down, but there's plenty of house prices in locations and regions that are still on the up, and that's what we specialise in at Dashdot, is identifying those areas. And I've got really strong faith in that process, and I've seen it happen. So that buffers, like, if you were just an average Joe going out and picking a house off the street, then there is that risk that you'll land on something that is going to go down, or that may not get growth for a number of years. But because of the data research that we do, and the data focused approach, I'm confident that we can get into that market at the right time and not sit there for 5 years waiting for it to grow, and avoid that worst case where we buy and it actually goes down in value.
Yeah, interesting. So you've obviously got an interesting perspective, because you're about to buy your 6th property effectively, right? So decent. So you're sort of like a, we'll say sophisticated investor at this stage. And also you're on the front line effectively in acquiring properties with clients, like helping them in that process yourself. Do you think that you've got an unfair advantage in terms of your understanding? Because you're like, well, the reason I can do it is because we've got a data-centric approach, but the average punter might not be able to do it. Do you think that is giving you an unfair advantage and in your approach? Or, like, if you were to remove yourself from Dashdot, would you still have the same opinion? Would you still be like, I'm going to move forward with it? Or how would you be thinking about that if you didn't have access to the insights?
Yeah, I do have an unfair advantage, and our clients at Dashdot have an unfair advantage because of that data-focused approach and the demonstrable results we've achieved. And if I wasn't in Dashdot, I would hope that there's someone like me that kind of has a deep understanding of what we do on the inside and have seen the results on the ground, and can build my confidence to be able to still move forward in a time that seems laced with risk if you read the headlines. So yes, I think that the analysis that we do in Dashdot gives our clients and Dashdot an unfair advantage over the rest of the market. So there's no denying that. But it's not me as an individual that gets that. It's anyone that uses our service, because that's what we do. That's the value we bring to the program.
Yeah, I think I'm just trying to like pick apart like because you've got effectively the curse of knowledge now. You're effectively going, well, yeah, I mean, of course I'm going to invest because, hey, you know, I can see all of this kind of stuff. But the average punter listening to this podcast might not have that. And so just trying to segment you can move forward because you've got insider knowledge effectively. Almost, I was going to say insider trading a little bit because you kind of know where's going to go up, but you know, how do we then position that against the general consensus thinking? I might actually flick to Nikki and Natalie, to you guys, because the interesting position that you're in the team that you lead, the people that you talk with, the communication that you have, and all of that kind of stuff, actually is with people who don't have that level of inside knowledge, right? That are their primary information source is you know, what's out there in the marketplace. So talk to me about how you guys personally are thinking about investing in this environment. You know, are you worried about what's happening, you know, what you're reading in the headlines? You know, you guys are on your second property, right? Nick's on his sixth, so it's different stages in the journey. You guys, but how are you guys thinking about it? Talk to me about that. Talk to me about emotionally, spiritually, all of that kind of stuff. How are you handling that? Do you care? What do you like? Talk to me about that.
Well, we have to care because we have to have this conversation every day with people. So we can, we'll break it down a little bit about how we're understanding it. But firstly, what Nick, you were speaking to, we're in the inner sanctum of Dashdot. So personally speaking, we completely trust what's happening and we get to see the results every single day. So that's a huge factor. But we then in the sales and advisory team get to impart that trust onto every, you know, ideally, and everyone we speak to, and we get to express that and take people through the journey. So essentially why we're investing is because if we didn't, we would essentially lose. The opportunity cost would be so much greater than any upfront cost right now. For example, the property that we're about to go unconditional on,
with the interest rate
rises currently, because we are, you know, at effect of that, it's going to be about minus $2,000 a year.
Interesting.
In cash flow. So we've tipped into, you know, the neutral/negative, which is essentially going to cost us about $30 a week each, right, over a year, which is nothing. Like that's just in So this is just year one. Year two, we start to go into neutral. And year three, we're back into positive. It's about that. And so $2,500 cost to us this year. Yep. That's about it. But the benefits of jumping in now and not being afraid of the environment or what the media is expressing and bombarding us with is the growth, the upside, the huge amount of growth that our properties in particular at Dashdot, you know, generate and create. Go for it. You want to ask something?
Yeah, I'm going to ask something. I'm going to poke on that a little bit, right? Because I'm super mindful because all of you guys are on the inside. So what I'm picking up is a theme here already where it's like, well, we already have the inside knowledge and we already know that this is going to work. So, you know, from our, and which can seem a little trite, I guess, if we're now talking to people who aren't, and that's cool. But like, let me pose a question to you. So you're buying a property right now that you know is going to be $2,000 to $2,500, whatever it is, cash flow negative in the first year because of current interest rate rises. My assumption is you're probably going to be on variable rates. So that could get worse, right? So you could go more cash flow negative, right? What if that property doesn't grow? What if? Talk to me about that. How would you feel about that? How are you weighing up that risk now? Because you can have a belief in our approach. You can have a belief in the track record. You can have a belief in all of that kind of stuff. But how are you thinking about that risk? Because this is really putting yourself in the shoes of everybody. Other people don't know. They're going to take a leap of faith. You know, like anyone who's investing is like, well, I hope it's going to go up, of course, right? And people will have varying degrees of belief, regardless of what information they've got. I mean, once upon a time, I believed that all properties doubled every 7 years. Right? I thought that was true, right? So belief is one thing, but how do you consider the risk?
Yeah, it's a really good question. And I want to sort of just to dig in and ask you another question to your question.
Go for it. Yeah.
So when you talk about that, what if your property doesn't grow? What timeline are you referring to?
Okay, that's fair. That is a fair question. And I didn't have a presupposed answer to that.
I know. And it's probably because where I wanted to go and what I wanted to bring to this question and this topic, it's something that's it's not necessarily some of our younger clients, and that's why I'm blown away by TJ and what he's achieved already. Like, it's incredible. But it's something that's personally come with age and with some biological years, and that is the idea of holding the goal and the vision. This is what we work with, clients and people all the time, but looking at stretching the timeline and giving a really healthy timeline. Most people, when they come in, especially younger people, they're just looking at the now, because everything's in the now in terms of living life. It's all in the now. We want it now, We
want our $100,000.
Yeah, just like everything in the now, maybe like this year, bang. And so it's about kind of looking at your life and sort of looking at, well, where do I want to be, 10 years, 15 years, 20 years. So like Natalie and I have a 20-year timeline with our vision. So
we're 20 or 30 years older than you, TJ. So.
Yeah, we're just going we're going hard in the build phase of our folio over the next, say, 3 to 5 years. And then we've kind of set ourselves up for the long term. So in terms of what's happening in the market, this is now. There will be a correction. Things will shift and change again.
And so if there is no growth in the next couple of years, we can stomach that.
Kind of like, who cares, right? That's your approach. It's like, well, that's you're not playing it for growth in the next 12 months. You're playing it for growth. Yeah, and that's
a long game. Yeah,
and that's a really interesting perspective, because what I have learned in my short amount of time and my limited amount of wisdom, etc., is that the people who care, like the depth and breadth of someone's success is directly correlated with their timeline to achieve that goal. So if someone is playing a 20, 30, 40-year game, they are significantly more likely to win than someone who's playing a 1-year game. And I just even on a person, I relate this to all areas of life. And personally, I've been looking at it. I did a health and fitness program, which was like, effectively hit your dream goals in like 6 months, and you can do it, and that's great. But then my psychology shifted to, well, what if I shifted that to a 3-year horizon, and what would how would I then approach my health and fitness goals if I was trying to do it over that macro? And what would that change? And in fact, it is so much more enjoyable, B, more likely that I'm going to hit my goals and keep the goals and see more sustainable. And so that's, so it's an interesting approach to shift that and think that, because I think that anyone who's looking for, what's going to happen this year is actually missing the point. He's actually missing the point. Yeah, TJ, I want to get to you, but Nick, you've got your hand up.
Yeah. So I just wanted to summarize a bit on that and chew on that a little bit. So I think there's that saying that it's not timing the market, it's time in the market. And there's a few ways to look at that, because obviously at Dashdot we do time the market as well as promote time in the market. But my firm belief is that the best time to buy a property is when you can do it. Like, you're not trying to get into the broader market at a particular time. The best time, like if I could have bought all my properties 20 years ago, like, I'd be laughing now. So every time you've got the capacity and you've got the deposit and you've got the serviceability, that's the best time to get into the market, in my opinion, because things often change. Like, your circumstances change, you have another child, or someone gets sick in your family, or your job changes, and all of a sudden that opportunity's gone. So when that opportunity is there, that you've got everything lined up, because there's a lot that has to line up to be able to purchase a property, that you got to seize that as soon as you can. And that's what I promote a lot with our clients like this. Like, should we wait another 6 months? And the 6 months is about, if you're going to be any longer than 6 months, I'd always say, just get in there, just get into the market. Because 6 months is probably okay to save up a bit of extra money or maybe think about it a bit more. But if it's going to be any longer than 6 months, I'm like, yeah, just get in there, because you'll thank yourself in a year, and in 10 years, you'll be, beyond grateful that you made the jump.
Yeah.
The opportunity cost is huge.
Totally.
Yeah.
There's a huge amount of opportunity cost in there. I want to point out, Nick, that's almost like dollar cost averaging. When they talk about like the best possible way to invest in shares is dollar cost averaging, where you just invest a consistent amount, on a consistent basis, regardless of whether the market is up, market is down, and you get like, I can't even remember what the maths is, but it's significantly asymmetrically greater returns by just doing it and doing it and doing it. And to your point, though, we are also making sure that we're buying in the right place at the right time. But then on the opportunity cost piece, it's really interesting, because I actually had somebody ask me just the other day, one of our clients who connects with me outside of, just connects with me independently as well. And he was like, "Hey, Goose, what do you reckon? Should I buy a $400,000 property in and I could probably do it in May next year, or if I wait until like July next year based on my savings, I should be able to buy a $600,000 property. What should I do?" And that was interesting, because okay, well, there's a significant difference over a fairly short period of time. But again, to your point, if you have to wait too long, then you're exposing, you're corroding your potential benefit with opportunity cost. And the other thing to point out there is with inflation at the moment as well. So even if your property doesn't grow, stays at the same value, you're still macro making benefit versus having your capital in the bank where it's actually devaluing as well. So, and relating this back to another angle. So there's in the kind of capital markets, business fundraising, people raising equity money and stuff like that. Most business valuations have been crunched over the last, 12 months or so. Everyone's seen that. That's why the share market's down, et cetera. And I was reading a story around a founder who had raised significantly high valued company, fast growth and everything like that, and had raised money, had managed to raise money, but at the same valuation as they had raised 6 months or 12 months ago. And there was a quote from him, which I loved. He said, "In this environment, having raising money at the same valuation is the equivalent of raising money at an increased valuation. In an environment where everything else is devaluing, keeping it the same is actually a gain." I thought it was really, really interesting. So, PJ, let's flick over to you, because you haven't got a word in edgeways really so far. How are you thinking? How are you thinking about investing in the current environment? Obviously, you're a little younger, right? And so, to Nikki and Natalie's point, different time horizons and all of that kind of stuff. What is your thought process around investing in an environment where the macro environment, people are saying, no, it's all going to hell in a handbasket. You've probably got people your age who are absolutely not even thinking about investing in property, who are probably even think property is not even for me. So there's probably a few other vectors that you might be thinking about this from. But how are you thinking about investing in the current environment?
Yeah, 100%. I think at the moment it's a very dynamic market, so it's moving around quite a bit. But personally, myself and my partner, we're charging ahead. We're keen to get investing. And I think
why are you charging ahead when so many other people are stuck in the mud?
I think it comes down to the mindset, and I think it comes back to what the team said here today. It's not thinking short term. If you think short term, that's going to hold you back. If you get absorbed into the media and the fear and what's going on in the market at the moment, that's going to prevent you from seeing your longer term goals. So my partner and I were thinking 10, 15, 20 years ahead. And in doing so, it's telling us it's better to invest now than to be scared and wait. And it comes back to your point as well about the devaluation of money. It's going to be not good for our financial position to leave our money in the bank and not invest it, in our opinion. So that's why we're interested in moving ahead. Obviously, choosing the right assets at the right time. We still think there's a great amount of opportunities in the market. And so we're keen.
Awesome. Yeah, interesting. Because there's a couple of things a thread that I'd like to pull on, strategic thread I'd like to pull on with all of you guys here. Inflation and interest rate rises. I'd like to pull on that thread a little bit because there's some implications on both. But Nikki and Natalie, you guys have got something to say?
Yeah, I had a question for TJ. I'm just really curious because you mentioned something about, some of your friends and others like peers or whatever have a bit of fear around investing in property. And I was curious whether, and I wanted to bring forward like the kind of alternative that we're seeing now with some people is like, well, should I invest in property or should I invest in shares? And I wonder if you could speak to that. I'm curious to know.
Yeah, of course. So I live in Sydney, and I guess most of my friends are very enclosed in the Sydney market, and they think properties are, the median price is 800, 900,000, $1 million. And so investing in property is never really a big thing here. It's always seen as out of reach. And I think that's the first barrier you have to get past, is being a borderless investor. If you want to be an investor, and especially if you live in Sydney, you have to go outside of Sydney to do so in this market, from my opinion. So I think property is a better option for me compared to shares. I think you can do shares, but they're two different asset classes. I think there's a lot of benefits with investing in property, more so the leverage side. I think that's a huge advantage and something that you don't find in other asset classes as much. So
well, you can, but
utilize,
it's just a way higher risk leverage, right?
Exactly. Yeah, exactly.
Yeah.
Yeah. So I think if you can utilize that leverage, that's going to give you compounding effects. So why wouldn't you?
Mm.
Awesome.
It's interesting, right? Because like just tinkering on that one a little bit. What is really interesting is like broadly the perspective. I spoke to Gabby's brother, who doesn't live in Sydney, right? Who lives in Victoria, completely different, who's not in Sydney, right? Let's just leave it at that. And I said to him, I said, hey, why are people your age not, like, why are you and your friends not interested in investing in property? And he basically said, well, we are, but properties cost $1 million. That was literally the throw. But properties cost $1 million. So, and this is a really interesting perspective, because if everyone thinks the properties cost $1 million, well, then it's like, well, I don't have $1 million. Now, the downside with that is that we also are in an environment where younger people actually want to invest more. They actually, like, once upon, go back to your parents, right? And the whole idea was like, I'm going to get a job and I'm going to work there for 50 years, get the gold watch, and then retire and mow the lawns, and life's going to be good. Whereas what's happened over the last couple of generations is now younger people are actually more like, what? I'm not sure if I want to be working after like 35. Like, how do I get out of this? How do I get out of this construct? I don't bugger the gold watch, give me a sailboat and let me travel the world, sort of thing. And so younger people are way more interested in investing and building wealth, but the perceived accessibility of that is lower. And so it pushes them into higher risk opportunities, because they're effectively go, well, real estate would be great, but I guess it's just not for me. It's just for boomers. So I'm going to have to choose a riskier option, meme coins, shares that they don't really understand, effectively gambling, which is really, really interesting, right? And I don't have a point or a follow-up question from that, but I just think it's a very interesting construct. PJ.
Yeah, I just wanted to touch on a personal experience. So I actually have some really close friends who live in Sydney, and they initially were looking to buy a property in Sydney as an investment, and it ended up being they went to an auction, and unfortunately they missed out on the property, but I think it ended up being a good result for them, because it was a tiny house, and the rental yields are really low. And I think in terms of building a portfolio, I don't think it would have been a good option for them. And eventually, through conversation with myself, they end up signing up to Dashdot and buying a cracker property in WA. And they've been really happy with that result. So I think it really comes down to the education piece. Most people don't understand what's the best way to build the portfolio in terms of asset allocation and capital allocation. So I think once you get past that and learn those important notes, you can really set yourself up for success.
Nice. Nick.
And I think that comes back to what we were talking about a little bit earlier. Like, do we have an unfair advantage? Yes. Do our clients have an unfair advantage? Yes. But I guess the threshold that needs to get over is on the buyer side, is on the broader populist side. They need to find or have a desire to scratch below the surface of what the kind of general population thinks the property market looks like and what the media portrays it as. Have to have a desire to do that. And there's numerous, organizations, ours included, that are more than happy to kind of bring the knowledge that we've accrued over time and through playing buying, hundreds of properties where the average investor might only buy 5 in there, or, if they're lucky, they'll buy 5 in their life.
Yeah.
Or one. So just through the sheer volume, we build a lot of knowledge, and we're more than happy and only too happy to offer that out for free. And so it's not about that we're an exclusive club, that we have a closed door policy. The only person standing in the way of actually making that jump to it's really a paradigm shift in your thinking about how this market operates and the opportunity that it can have. The only person in the way to that is the individual sitting out there, sitting on the fence.
Yeah.
Like there's numerous, and it's not just Dashdot. There's hundreds of other companies out there that have similar understanding to us, but different methodologies, but similar understanding, and we'll give that advice for free.
Yeah, that's interesting. So all of you guys are in a position to be talking to, we'll say the general public, right? The people that aren't on the inside, whether they be friends, family, or people that are thinking about working for Dashdot and come and chat with us on the front end, who exist in a different mental paradigm, right? So how are you guys approaching those conversations? Because what we're actually talking about here is we have an opposing consensus perspective, because we've got an unfair advantage and a different exposure to information. And so if the consensus is, the world is bad and everything's going bad and all of that kind of stuff, and don't invest, etc., all of that kind of stuff, the consensus that we have is completely the internal consensus is different, right? So we have so how are you guys going about having those conversations with people? Because sometimes, sometimes having an anti-consensus thought can seem a little bit tin hat, either side, right? It's like, why do you think that? And are you just brainwashed in a certain way? And that can go in any way on any discussion. So how are you guys approaching challenging those paradigms in an empathetic and constructive way to help people actually move forward? And Nick and Natalie, I might actually throw to you guys first, because you guys are on the kind of like the leading edge of having probably hundreds of those conversations, either directly or through the team on a regular basis. How are you doing that? How are you approaching that kind of that fear, that paradigm shift, and actually presenting a new opportunity without it being just sort of some rote cult-like, we believe different?
Yeah, cult-like. Obviously there's different start points of conversations, meeting people with what their particular concern is. But, there's obviously some truth in the interest rates have gone up and starting there with some empathy. Yeah, yes. So how do we now approach this with this knowledge, with our intel and technology and the way, our strategy, and how can we still forge through? And so meeting them where they're at, and then backtracking it, making sense of it with the numbers and the proof in the pudding, ultimately. When we looked at our interest rates, it almost, we on our current property, our repayments have gone up quite significantly. So we, there's some facts here, but how can we use all of that and craft a strategy that works right now? And that's the job of our team, is to work that strategy. Awesome.
Okay, I'm going to leave that. Sorry, Nikki, you're going to say something?
Yeah, I just wanted to add. So what we do is we just have an open conversation, like the Band-Aid's off, here are the numbers, here's how it works, here's our personal situation. So we've got that to bring to people. So, just helping people to understand what is out there. We can't control, and there's fear that happens. So, and the biggest killer of someone, moving forward is this sort of inertia from things that are outside their own control. So what we try to do is help people understand it's just, how can we help you, support you to make the step forward towards what it is you want to create in your life.
And bring you back into control of your own destiny, rather than being controlled from our other sources.
Internal locus of control versus external locus of control, right? You're in control of your own destiny versus it's all happening to me, right?
I've got no control. It's happening.
Yeah, it's all happening for me.
Yeah,
That's
exactly. Exactly. So I'm going to leave that question hanging, because I'd love to get everyone's kind of perspective on that. But also, interest rates are going up. and it does affect cash flow. Let's all just be like, let's be super real about it. There's no point going, yeah, life's great, just like keep doing what you. I personally know someone who had roughly $99,000 of net cash flow in their portfolio. We'll call it 100 grand, which got knocked down to about 35 grand. Right? So like this year, it's gone from like 100 grand cash flow in the portfolio down to about 35 grand roughly cash flow in the portfolio. That's significant. That's not a couple of grand negative. That is like, whoops, wow, okay, that's all just disappeared. So it is real, right? And the scale and loads of different things impact it differently in different ways. So how are we, like, we'll just open up the floor and we can just and everyone's kind of like putting their hand up in the thing, but maybe we'll just have a free for all. I don't really mind. How are you guys thinking about that in your own portfolio? How is that changing your strategy? Is that changing the way you're thinking about client strategies? Like in a real practical sense, how is that shaping up for you guys?
Yeah, I can talk on that. So that one of the things I love about this job is that we get to have those conversations with clients and do those thought experiments all the time. So have a fairly deep level of thinking around, the emerging issues of the different portfolio stages and the different market, what's happening in the market as well. So conversation I had with a client, and this is what I've done in my own situation, is basically like have a look, get a good understanding of where your portfolio's at, what hit you can take, and at what point you'll be going backwards, and make assertive action or points or thresholds where you'll take assertive action to preempt what's likely to happen anyway. So if I'm hemorrhaging money and it's beyond what I can sustainably contribute to bring it up to parity. So if I'm losing money on my portfolio, I've obviously got some money in the bank. And if I can see that's going to go backwards and I'm going to end up, in trouble in 6 months, then part of my action plan is to know that, once that happens, this is the first property that's going to get sold to bring some of that debt down. And that's the poorest performing property in terms of return that it's producing on its value on the market. And so there's a bit of an action plan for if things keep going up, if interest rates keep going up, then that's my kind of course of action. It's taken me a while to actually get my head around that. And the other thing I wanted to say, back to what we were talking about quite earlier on, it's not I raised before that the best time to buy property is when you can. That decision needs to be an informed one. So you need to be able to assess what it means to you if you buy a property now. Is it going to be, if it is negative cash flow, can you sustain that? Like, it needs to be definitely a informed decision. You don't just go out frivolously and go, I've got 100 grand in the bank, I'm going to go and buy a property.
The can I piece is more than just, do I have the deposit and the borrowing capacity?
Right.
It's the macro from my whole life perspective. Can I do this right now? Does it even make sense? And also, just to that point, and sorry to cut you off, Nick, that also lends into macro life planning and stuff too. Like, because what if you've got 100 grand in the bank and then, I can buy a property, but then you go put your bank account to zero, and you don't have any risk buffer in your own life, so what happens then? Cost of living is going up. And so the can I question is a little bit of an onion. You got to pull on it and make sure that you're really thinking about all the second and third order consequences. But then within the context of that, if you can, then go for it, right?
That's right. Yeah. So the point is, if everything lines up, don't sit out of the market waiting for the market to change and be a better time in the market to do it, because before you know it, your personal situation changes and you can't actually make the purchase anyway, or you've lost, however long out sitting on the sideline of the market and that opportunity cost that we just talked about.
Nice.
Yeah. Can I just throw something in there? Yeah, the first property we bought, in 6 months, it had grown 11% in growth, and we were able to tap into that. So if we'd sat on the sideline and waited 6 months, it's just like, there's the lost opportunity. Right,
and then the cost of that same property
would have gone up. Exactly. To purchase that same property would have gone up. So
so not only would you have not gotten the growth, but if you had tried to buy that same property in a theoretical example, you would have had to pay more for it, so it would have cost you even more anyway. So
double.
Exactly. That's huge. TJ, you're going to say something?
Yeah, I just wanted to add to that as well. Just with the rising interest rates, for me, how I view it, it means you have to be much more careful in your asset selection. That's how I view it in terms of planning out your portfolio. there's less room for error, in my opinion.
Interesting. What do you mean by that? Let's pull on that thread. That's interesting.
Yeah, I think if you don't approach your portfolio in the right way and buy the right assets at the right time, then I think that's going to set you up for more opportunity to get stuck in terms of serviceability and capital. So I think it's really important to understand what's the right type of asset and what price point at the right time, depending on what you're looking to achieve in your goals.
And has your perspective on what the right type of asset, has that changed because of the macro environment?
Again, it's all dependent on where you're at in your portfolio. So there's still great assets out there to purchase, but it may mean that you might need to readjust your strategy according to your financial position. So I think that's why it's important to plan ahead. And my dad always said with the 5 Ps, prior planning prevents poor performance. So I think that's really prevalent at the moment.
There's one extra P in there, piss poor performance, right?
Exactly.
It's like you missed a P.
Yeah.
I love that. TJ, when you say asset selection, are you talking about property types?
Yeah, exactly. So what kind of focus you're looking for in the property, whether it's more towards capital growth or it's more towards cash flow.
Right.
So I think that's really important in this current climate.
Great. The other thing I just wanted to add, which is sort of tying back into what TJ was talking about earlier, we were talking about the share conversation. So we coming back to if you're looking at, should I buy a property? Should I buy shares? With shares, you might get growth, and there's at a higher risk, of course. But looking at the cash flow, and then you can't necessarily tap into the equity growth to continue growing that share portfolio.
Yeah. I mean, I personally pulled my money out of shares to put into property. So that's how I kind of view that situation. I think
not financial advice. Not financial
advice. Yeah, put that out there. That's just my own personal experience.
Yeah, interesting.
Yeah, I think the secret sauce in it, though, like as TJ said, is the leverage. Like if you compare shares, if you had cash to invest and you compare shares with property, like I'd be on the fence as to which one's better, particularly because property is definitely not passive where shares are. So property does take some of your energy to, review tenancy applications and get repairs done and things like that. So if you're looking for a life of freedom, choice, and abundance, all else being equal, if you had a few $1 million of cash in your hand now to produce a passive income from, I'd be willing to have that argument about whether shares might be a better thing to do. If you're not looking for the growth and you're not trying to utilize that leverage to supercharge the growth, then
most people come in and have got like 100,000.
That's exactly right.
Yeah, that's the point.
Yeah, and to your point, it's like if you had a few $1 million to invest and also didn't want to use any debt, right? If you were like, do I just buy properties in cash or do I just buy shares in cash? So I guess the other thing that you've got to consider is also like, what is the point? Like, what is the purpose? What are you trying to achieve? Is it, to TJ's point, is it growth or is it cash flow, right? Because, if you're like Warren Buffett, he's effectively just investing for cash flow, right? Famously is like, don't buy a share that you wouldn't want to own if it went down by 50%. It's like, why are you buying it? And so if you're buying for cash flow, there's some really high dividend, high yielding shares out there if you're just going to buy cash versus what your net yields may be, even buying properties in cash, etc. But for part of the benefit obviously with property is the leverage that you can get, and obviously the return on the capital, and don't get me wrong, you can get significantly, you still can in many cases get really solid yields, and I was going to say better than shares, but I don't know that to be absolutely true, so I'll kind of like say that with the caveat. I'm very interested to get your perspective on this, and this is a bit of an obtuse and left of center question, but inflation's going up. So as inflation goes up, interest rates are probably they are going to go up to be able to tame inflation. When interest rates go up, the cost of capital increases, which is specifically why business valuations go down, because from an institutional investor perspective, they've got to think about the return on capital versus other assets in the market, etc. And so shares, businesses valuations get squeezed a little bit. So if inflation is going up, which means that as the relative rate that inflation is going up, it is devaluing your cash at bank. So the actual purchasing power of your money is going down. So in real terms, your cash is degrading in value. And also, as inflation goes up, most businesses are going to have squeezed valuations. Macro, we just sort of as a generalized perspective, shares are going to go down. Do you think that what is going to happen is that more and more people are going to push into the property market? Do you think that that is going to happen? Do you think that we could end up with an spiraling cycle where everyone tries to shove their cash into property regardless? Do you think that, I'm interested theoretically where you think that is going to go? And I don't have an exposed perspective on that. I'm just curious on your thoughts, because I was talking to somebody the other day who was very much like, the inflation spiral is going to get out of control and everyone's going to go throw all their money into property. And, this guy lives in Japan, right? And he's sort of seen other markets, but it was a very interesting perspective. And I was like, generally could be true, but I'd be interested to get your thoughts. Anyone?
Interesting.
I don't have enough intel on an answer for that. I would like to throw it to Nick. I reckon.
The thing also, is it Ankle Patel, the 18.6 year?
Akhil Patel came on the podcast, but it's actually his name escapes me. But yeah.
So that's the kind of the overlying lens that I consider these things in. So I think what you say is true. There's numerous forcings that are going to keep pushing property prices up at the moment. So there's what you just talked about, the move to hard assets, which are a hedge against inflation in an inflationary environment. There's the increasing migration into Australia. There's the super tight tenancy rates at the moment. So there's lots of things pushing prices up. And, I think at some time there's got to be a big correction based on that discussion in the podcast with Akhil Patel. That was going to be around 2026 based on that 18.6 year.
When you say big correction, cycle. Do you mean a big correction in property, or what do you mean by that?
Like in an economy. That's how I understand it, but partly triggered by property. So it's a big correction in the economy. So a major event like a GFC type thing.
Yeah.
It could be triggered by anything, but the way the cycles work, as I understand it, is we keep rescuing it and it keeps ramping up so that the fall gets bigger, and like the height that we reach gets bigger and bigger, and the fall becomes bigger to get back to what is a fair, reasonable market value for property and for other assets or something like that. So in answer to your question, I think that is a cycle that we're in, and there's a number of years ahead of us still of really good returns in property. But I think that when I'm personally looking at it, I'm kind of positioning myself for that and making sure I'm not totally too leveraged approaching that point. And that ideally I'm in a position to be able to, make good of that situation if and when it does happen.
Interesting. Anyone want to riff on that, or anyone want to pick up on that thread, or we can go and shift in a slightly different direction?
I guess I'll add something. In terms of the share versus property debate, I guess there's a few ways to look at it. I mean, if you're looking at it from a short-term perspective or a long-term perspective, I don't think shares are necessarily a bad asset to have. And just because there may be potentially a downturn at the moment doesn't mean it's not going to recover. So I guess it's really about what mind frame you're looking at. And you might argue that with shares going down in prices at the moment, it's a great time to buy and pick up shares or great businesses at a cheaper price. Those businesses for the most part are still going to be around if you have good faith in them. So there's an argument that way as well, I think.
Yeah, it's interesting, isn't it? It's interesting. So what advice would you have to someone who's just listened to this for the first time, and he might be like, well, we're in a big dip at the moment. The economy's going bad. Are we going into recession? Like at the time of recording, US inflation has just gone up. It's, things are. What advice would you have, TJ, to someone who maybe hasn't even started their journey, right? And is kind of just going, well, what do I even do? What do I do right now? What advice would you have?
I think the main thing for me is to get educated, to gain the knowledge from people that have gone through these experiences. I mean, these kind of downturns have happened in the past. So there's lessons to be learned from history, I believe.
You say downturn, you mean economic downturn, right?
Economic downturn, correct. Yeah. So I think, listening to podcasts like Investor Lab, as well as there's plenty of other resources around. If you get that knowledge, it gives you more confidence. And if you have the confidence, you can make better sound investment decisions. So that's where I kind of come from. Everyone's in a different position. So I think unless you have a sound understanding of what's going on in the economy, that's only when you can make good decisions for yourself.
Nice. Anyone else got advice for someone who might be just starting out, or potentially someone who's got a few properties and is wondering whether to move forward?
We've been here before. What you, TJ, were just saying, like history has. We've done this before. The most successful people have actually taken action during these times, and we have to elongate our timeline, and not so fixated on right now. That is the short-term thinking. That is where people get stuck. That's where people get fixated, and they don't make decisions, and they look back and they wish they had. If I'd bought that then, I actually would have been here. And we're right in that time zone. Like if we believe the media, we will jeopardizing ourselves with cutting off a limb. Absolutely. Longer timelines.
Nice. What about you, Nick?
Yeah, I think it was the same thing. Like if I had the opportunity now, knowing where history is going or where we are now, to go back and invest during the GFC or even immediately prior, I wish I had done that. Even though that we've rode through some pretty bumpy ground since with that, and then obviously the pandemic. But in the longer term horizon, all that's kind of not that significant in the scheme of things, as long as you can weather that downturn. So I think you need to have an informed position about what the worst case scenario is, and can you weather that, or what's your action plan as things go bad, which is what I was talking about earlier, and what TJ just said. If interest rates go up another 2%, which I don't think is unbelievable, I think that could happen. What's your action plan, and what are the thresholds where you need to take some action and be in control of that action, rather than having it foisted, is that the right word? Forced upon you from the bank or whatever. So you want to do it on your own terms. If you need to sell a property, you want to do it on your own terms. If you need to take, mitigating action so that you don't end up bankrupt, you want to be the one that's in control of that, not have a public trustee or whatever doing that.
Nice.
So the point being, you've got to understand your position and whether you can weather what's, a reasonable worst case scenario. But the fact that there's a potential downturn, or there's a very likely downturn on the horizon, in my opinion, doesn't necessarily mean you shouldn't invest now. And in fact, if I could have invested back at those downturns previously, I would have done that. So I don't want to be sitting here in another 10 years going, wow, I wish I'd put some more money on the table in 2022.
Yeah, that's exactly my point of view as well. It's like, even if you just go back to April 2020, what would I have done differently if I could go back to April 2020? Like consumer confidence was at about the same level. It's like, what would I have done differently then that would have set me up better today is an easy frame for people, because GFC is quite a while ago. A lot of people are not like, but everyone can kind of remember back to April 2020 and how they felt and what the environment was like and what the news was like. Everyone remembers it. It's not very long ago. So even just going back to then. Final question I want to ask everyone here, because we're talking about an economic downturn or economic turbulence or economic, there's like, we say that, but also unemployment's at record lows and all of that. Let's just say there's economic gyrations is probably the best way to think about it, because there's some bits that are going one way and other bits that are going another way. It's like, it's swinging around all over the place in a variety of ways. So I think gyrations is probably the closest thing that we get to understanding what the economy is doing right now. But my final question to each of you individually is, with the media telling us that the property market is going down and the property market is crashing, particularly if you read the paper, my question to you is, based on what you know, with your access to inside knowledge, is it? Simple question. Is the market crashing?
Simple answer, I think no. It just depends in which areas you're buying it. There's plenty of markets in Australia. And I tend to not really focus too much on what the media is saying, because I understand there's other motives there. They're out to grab your attention and to get revenue from advertising. So for the most part, they're sensationalizing what they're saying, and it's not the complete truth. So I tend to look at the data, and that the data will give you a better understanding of what is reality. And in plenty of markets in Australia, they're going up. So,
Nikki, Natalie?
And that's why I have faith in our generations, because of what TJ has just said. That's awesome. Everything that TJ has just said, I absolutely 100% agree. Ditto. Yes, full confidence. Again, take the internal stance. Everything that is in the way of you actually moving forward is
typically a lack of education, lack of understanding, knowing what we know inside Dashdot.
Lack of insights. Yeah.
And on the other side of that, on the other side of a decision is the momentum that is, once you do get started and you move towards, like, now we're in our second property, coming towards settlement. It's a far different experience. I'm sure, TJ, you'd agree, right? Like the second time, and I'm sure then there'll be the third and the fourth, and having that momentum, it gives you confidence. You've got education, you know what's going to happen. And as Nick said, managing and doing this, smartly, with all the numbers in front of you.
Yeah, nice. Nick, is the property market crashing?
I think it depends on where you're focusing your lens. So if you're sitting in Sydney, it's like what TJ was saying earlier. If you're sitting in Sydney and your lens is focused on Sydney, you probably can't afford a house as a millennial. And the same argument, if you're sitting in Sydney and your lens is trained on Sydney, is the market going to crash? Yeah, I think there's probably going to be some more funds shaved off house prices in Sydney. But if you broaden your horizon to the whole of Australia, then yes, you can buy a property as a millennial, and the whole of Australia is certainly not going backwards. And obviously, we've got the data to demonstrate that, and we share that openly with our clients on a daily basis. But it's just about opening your horizon to look at a broader market and a broader geographic area, and it's very easy to spell that. Well, I'd call it a myth. It is a myth. The property price isn't crashing as a rule across Australia.
Nice. Love it. Guys, well, thanks. I've actually really enjoyed this style of discussion, so maybe we'll do it again. Really great to have you on. Really cool to hear how you guys are thinking about all of this kind of stuff, as you are in market, actually buying properties for yourself, walking the walk, talking the talk and walking the walk, and actually doing it and go, well, this is how we're thinking about it. This is our actual perspective whilst we're actually buying properties in the current market. I think it's a really valuable perspective to have, because a lot of people are just like, not really sure. So I think this is actually really super valuable. I've loved hearing all of your thoughts and general insights. Lots of good ground covered. So thanks, guys. Really appreciate you coming on.
Thanks, Goose. Thank you.
It's been fun. Thanks.